Hi everyone. In this lecture, we shall be discussing securitization, the basics of securitization. It is chapter 7 of AFM. Before going deep into the subject, let us start with an example. Let us take the example of a software company. Now, this company makes softwares and sells to the client. And suppose it is having only one client and one employee. And this employee is a developer. So, as of now, this is a company which sells softwares to this client, and the software is developed by this developer, which is an employee of the company. Here, now in the month of January, the company made a sale of 10 lakhs to the client, and the salary to be paid of this employee is 6 lakh. Now, which is very clear here that the company had made a profit of 4 lakh. Here, in 1 month, the company made a sale of 10 lakhs, and the employee salary which the company has to pay to this developer is 6 lakh. And with this transaction, the company has made a profit of 4 lakhs. Now, assume the sale is made on 15th of January, and the company has given a credit period of 60 days to the client. That means the client need to pay this 10 lakh to the company only after 60 days from raising the invoice, right? So that means it is a credit sale. The client has 60 days from the date of invoice to repay that 10 lakh to the company. Now, 30th of January came. On 30th of January, the company will anyway have to pay this salary of 6 lakh to the employee, right? Employees won't give more than 1 month credit period or anything. They just ask the salary on date. Every employee expects to pay the salary on date. So that is 30th January, the company has to make a payment of rupees 6 lakh. Here the company is in a slight liquidity crisis. Company doesn't have any liquid assets. The company doesn't have any investments. It is a very new company. It has just one employee and one client. It made a sale. It has earned a profit of 4 lakhs. That is there. But unfortunately, on 30th of January, the company has got all what is accounts receivable of 10 lakh. It doesn't have liquid cash. It doesn't have liquid cash with it to pay the 6 lakh to the employee. Now, this is a liquidity crisis where you don't have funds to make your immediate payments. Now, to this problem, most companies would face this problem, where the companies are in service-oriented companies will face this problem because most of their receipts will be in the form of accounts receivable because they will have to give credit period to those clients. But however, the employees who work for the company or mostly the consultants will have to be paid on time. Now, what is the solution to this problem? The first solution is take a loan or a borrowing from a bank of rupees 6 lakh and use this to pay the salary after 60 days. When your client repays the accounts receivable of 10 lakh, the client will be paying you that accounts receivable, right? The client who purchased the software from you, who took a credit period of 60 days, after 60 days, he will be paying you back that 10 lakh or he will be fulfilling his accounts receivable. With this, you have to repay the loan of 6 lakh plus pay interest also. And then interest may be like 1 lakh. Assume 1 lakh is a very huge amount, but still assume interest is 1 lakh. And then your profit is only 3 lakh. Your profit reduced to the extent of this interest, but still it is a fair deal, right? Because when you wanted funds, you got the funds and you just need to you had to pay the interest. However, you ended up with a profit of 3 lakhs. But this solution is not acceptable for everyone. The reason is debt. This solution increases the debt of the company. The solution increases the debt equity ratio of the company, the financial risk of the company. Though taking a working capital loan, so basically this loan which we took is in the nature of a working capital loan. Many banks provide the service of working capital loan when you are short of funds for your working capital. It is a common way of mitigating this problem. But however, this is not acceptable due to these reasons. The equity shareholders, they would never expect, or they won't want the company to take more and more debt where their financial risk is increased, where the debt equity ratio of the company is increased. So that is why this solution to our problem is not acceptable always. And the second solution, second way of dealing such a problem is securitization. So securitization is that process wherein what you are doing is your assets, that is accounts receivable in this case, which are mostly illiquid, you are trying to sell these assets to a third party and get funds. In a simple way, I'm explaining here. You are trying to sell your illiquid assets to a third party or an investor, and with this sale, you are trying to get those funds back into your system. Now, let us see the definition of securitization. Securitization is a financial process that involves combining assets into a pool. So, this assets in our case, the example, it was the accounts receivable, combining those assets into a pool and repackaging them as securities that generate interest, and the resulting securities are sold to investors. So these investors are our third parties. So our assets are being sold to a third party or an investor, thereby we are receiving the funds. And once when when this asset generate its own funds, in our case, the collection, which comes at 60 days, that has to be paid back to this investor. Here, mostly securitization is done by financial companies like banks. In our example, it was the accounts receivable. Banks will usually have loans receivable, credit card receivables. So these are their assets. These are the assets of the bank. These are receivables from which immediately the bank may not be getting funds. But if the bank needs funds, it can go for securitization. What the bank will do, they will combine the assets into a pool. The bank will combine these assets into various pools based on what? Based on their credit rating, based on various criteria, like all automobile loans into one pool, all credit card loans into one pool, all gold loans into one pool. So various pools will be created, and based on that pools, securities will be repackaged as securities, and that securities will be sold to the investors. These assets pools will generate interest and principal repayment for the investors. Now, this will be your asset pool. When the original borrower of these loans repays interest and principal, that will be paid back to the investor. An investor will be investing, or they will be buying these loans or securities which are backed by these loans. And when the original borrower of these loans starts repaying, that will be given to the investors. Now, the credit risk is being transferred in this process. The credit risk is being transferred in this process. For example, in our example, now I had an accounts receivable from a company for 10 lakhs. I had an accounts receivable of 10 lakh from this particular client. This client has to pay me 10 lakh. What I have done here in securitization, I'm selling that particular 10 lakh. I'm selling it to a third party, and this third party is already paying me that fund. Now, whether this client will repay 10 lakh or not, that risk is taken by this third party. There are multiple ways of securitization in which the risk may be transferred, may not be transferred. But in those cases of securitization, when the risk is transferred, it functions in this way. This risk of this client paying or not paying this 10 lakh will be with the third party. Now let us see what are the steps involved in securitization. The first is asset origination of the asset. So in our case, when credit sales are made and accounts receivable is originated, that is how the asset origination. So here asset is the accounts receivable or the loans. In case of a bank, bank is the lender. When the lender is issuing the loans to borrowers, that loan is the asset. So first thing, the loan or the accounts receivable is originated, which is the asset origination. Second step is create an asset pool. Multiple loans which are given by the bank, I am creating different pools based on these are auto loans, these are gold loans, and then there are also loans from which where the credit rating is too good. So based on the credit rating I can pool, based on the nature I can pool. The lender selects a pool of loans with similar characteristics such as loan type, maturity, credit quality, and this pool of loan will serve as a collateral for issuing securities. Now these are the various pools which are created, and these pools will be the collateral with which I will issue securities in the market. So securities will be issued in the market, and the purchaser of those securities, a person who is investing in those securities, what is his collateral? His collateral is this loan pool. So the person who bought the securities, he's so sure he in future I'll get the money from where? When these auto loans are repaid by the original borrower, when this gold loan is repaid by the original borrower. Here, and the third step is create a special purpose vehicle. So here, this is little, in this case, there is a lender, bank. The lender has given a loan, borrower. Now this loan is made as a collateral, and we also have an investor. The problem is, suppose based on this collateral, if investor is giving money to this banker, now already this bank is having what? Liquidity crisis, correct? That is why, because the bank already has a liquidity crisis, in our case, our software company, it is having a liquidity crisis. That is why it is going for the securitization. So the investor will have a doubt, what if this bank goes illiquid? Or what if this bank goes into bankruptcy? My funds are gone. So to protect this investor, a special purpose vehicle is created wherein there is no link between this investor and the bank. First, a special purpose vehicle will be created, and this complete loans will be transferred to the special purpose vehicle, and this investor will be giving funds to the special purpose vehicle. So the whole transaction is routed through a special purpose vehicle or a special purpose entity. Now, it establishes a special purpose entity which is designed to be bankruptcy remote, meaning that if the lender goes bankrupt, the assets held by SPV won't be affected. If this lender bank goes bankrupt, the assets which are held by this SPV will not be affected. So the investor can confidently keep money with the SPV, because even if the bank goes bankrupt, his funds, the investor fund, will always be safe with SPVs. That is why, that is the reason why we have to create a special purpose vehicle. The fourth step is transfer the assets. The lender will sell the pool of loans to the SPV. The lender will sell the pool of loans to the SPV, effectively removing the assets from its balance sheet. All the loans which the bank is planning to securitize will be sold to this SPV. That is how, that is a transfer of asset. With that, all the assets will be removed from the balance sheet of this bank, of the lender bank. In return, SPV pays the lender for the assets, often using funds raised from issuing securities. And in return, SPV will pay the money. SPV will provide funds to this bank in return of selling these assets. And how SPV is getting these funds? SPV is getting the funds from the investor. To the investor, SPV is giving shares or securities and funds. The fifth step is tranching. The SPV divides the pool of loans into different risk classes, also known as tranches. Each tranche has a different level of risk return, catering to different investor risk appetite. So there will be multiple investors, various types of investors in the market. Some investors want higher risk and higher return. In some investors, on the other hand, they require lesser risk and lesser return. So SPV, all multiple pools, SPV will be bifurcating into various trenches, and these trenches will be based on the reward risk portfolio or reward risk nature of each of these loans, and that is how each investor will be catered. Like each investor, based on his risk reward requirement, he can take each trench. And the sixth step is credit enhancement. SPV may use various credit enhancement techniques to make the securities more attractive to the investors. This can include over collateralization or reserve accounts, third party guarantees. So basically, SPV need to gain the trust of the investor. So credit enhancement means credit rating enhancement. What product or what security the SPV is selling in the market, showing what security the SPV is asking money from the investor. SPV can increase the credit rating of that particular security in various ways. One is over collateralization. For example, the loan portfolio based on which is acting as a collateral for this security, the worth of that could be 10 lakhs, and the SPV is only asking 5 lakh worth of securities. So the investor need to make a payment of only 5 lakh, but the collateral is 10 lakh. So that means it is over collateralized. Then it can also take third party guarantees. These are the various ways of credit enhancement or credit rating enhancement which the SPVs does. So these are the steps involved in securitization.